Hello and welcome again. I've titled this video Technical Analysis 101 because here we are going to be touching the tip of the iceberg. There's plenty of more to come, but in this video, like I said, we are just going to be scratching the surface and getting ourselves ready before we get our hands onto the advanced strategies. So let's get going. Okay, in this video we are going to be using probably 5 of the most widely used tools as far as technical analysis goes. Obviously there are many more, but I would say these 5 could easily cover up as much as 80% of the the actual technical analysis resources you are ever gonna need. So let's get going. First of all, we're gonna review support and resistance. Then we're gonna be looking into trend lines, channels, moving averages, and finally indicators. Now, as far as support and resistance goes, a rather popular definition would be that support and resistance are those specific price levels in your chart, horizontal levels, meaning one specific price level, in which the control of the situation, the main force driving the market, has exchanged hands from the bulls to the bears or from the bears to the bulls. Now, I know that may sound a little bit confusing. I know it does, but I'm sure you'll get a much clearer picture with a graphical example. Let's imagine the typical Forex chart where price is moving up. The bulls are in control of the situation. The buying pressure is outperforming the selling pressure in this market, and therefore price is going up. Let's imagine that price sharply bounces off that level, of one precise level, in this case, this horizontal level, and from there price begins to turn around and the bears get in control. The bears become the main driving force in the market. Well, that precise level, okay, this horizontal line would signify what we call a resistance line. Conversely, same chart but the other way around. If we've been going through a period of downtrending price action, meaning the selling pressure was higher than the buying pressure, and therefore the bears have been in control, and all of a sudden the bulls come in play, price turns around and bounces back up, well, this is what we would call a support line, okay? Probably it's just better if I just pull out my charts and I draw some horizontal support and resistance lines. I'm sure you'll get what I mean right away. Alright, as you can see, this is a real Forex chart. Is the sterling pound against the American dollar on the 1 hour time frame. And this is a clear example of a resistance line. Price has been clearly trending up. The bulls have been in control for quite a while, all the way from the 5th of December all the way to the 17th of December. So they've been in control for almost 2 weeks. And at that precise level, price decides to sharply turn around, and from there price plummets down all the way from 156.90 to 148.90. So that's quite a heavy drop all of a sudden. Therefore, we would mark as technical analysis traders this line, this level, the 156.90. It's a little bit above that, 157, let's say 157.00. We would draw a horizontal line in our chart, and just to make sure we remember that this is a resistance line. Now let me show you another example. If I scroll forward a little bit in time, there we are. This was the previous resistance line, and from there we can clearly see how the bears got back in control of the situation. They drove price down, again from the 17th of December down to the 29th, almost the 31st of December. So that's another 2 weeks of bearish downtrending price action. But at this level, at this time, again, the 29th of December, the 30th, the 1st of January, somewhere around there, price found support. At this level, you see how price found support actually 3 times. It bottomed out at that level, then it tried to breach below again a few days later, and finally on the 2nd of January, the burst attempt for a 3rd time. Actually, let me clear that up. Right there, we had a first attempt there, then a second attempt there, and finally a 3rd attempt by the bears to, well, breach below this level, the 144 double O level. They failed to breach through, and from there price bounced back up. So that's clearly, we would mark a horizontal line in our chart to make sure we remember this is a heavy support level. Once again, 144 double O. Okay, another example. We are still on the sterling pound against the American dollar 1 hour time frame. I think this is a prime example of what support and resistance look like on your chart. So let's review them all together. Starting from the left end of the chart, we can see how price went through a rather clear period of bullish price action. Price went up all the way up to that, where we found a 2-point resistance level there and there. Okay, do you see that? From here, price topped out and price turned around rather sharply. So I think it's fairly easy to recognize a resistance level at 153.62, 153.60, somewhere around there, with this double point resistance line. All right, resistance level. Now from there, the bears regained control of the situation. They drove price down for a little while, not too long, about maybe from the 9th of January all the way to the 13th. So that's about 4 days there, and then we entered a period of sideways a congestion area. Price didn't quite move up or down. It just moved sideways. But we can clearly find a triple point of support. You see that? How the bears were driving price down. They got rejected off this level once. They tried to breach again. They got rejected twice. They tried once again. Poor bears. It certainly wasn't their day. And from there, they got rejected for the 3rd time. So I would say this is another prime example of what a support line should look like. Let's mark this one in blue. All right. So again, 144.67. Triple point support level. From that, the bulls drove price up very temporarily, to be honest, for just 1 day, all the way up there. And well, it's rather obvious that price turned around there, didn't it? So let's mark that line in red since it's resistance. Right there, 149.82, another prime example of resistance. We have the main resistance line on this chart, which is at the very top of the price formation throughout this period of time. This is our main level of resistance in here, but then we have a secondary level of resistance right there at 149.82. Now from there, price turned around. It found a little bit of a temporary resistance right there at our former level of support at 144.67. It found support a little bit there for just so long before finally bang. The bears were powerful enough to drive price through. Actually, let me zoom in a little bit more. Okay, there we are. This was our secondary level of resistance, and this was our triple level of support, which, well, it helped the bulls to fight back the bears for just a little while, but from there, boom, price just reached through and well, it dropped down like there was no tomorrow. So zooming back out again, if we take a look, well, we could obviously keep on scrolling through forward in the chart. We would find another main level of support there. Since it's support, let's mark it in blue. 135.01, 134, 135.00, somewhere around there, and of course we could keep on scrolling forward. Now what's important, what I just wanted to show you in this chart is how it's not that difficult to designate, to mark the horizontal levels of support and resistance. Okay, we have one main level of resistance there. We have another main level of a secondary level of resistance, actually. Then we have another important level of support there with that triple level of support. In fact, we had a price found support there once again, and well, as we scroll forward in time, we have another one there, but so on and so forth. Like I said, yes, another example of how you designate, how you mark your key levels, your key turning levels in your charts, in order to be able to, well, conduct your technical analysis based on which you will be taking your trading decisions as soon as we get into the advanced techniques. So, to sum it up real quick, support and resistance are horizontal levels, specific horizontal price levels, where price stands around, like I said, in specific levels where the bulls get to beat the bears, or the bears get to beat the bulls. Obviously, if price turns from going up to going down, that's a resistance line. If price is turning around from going down to going up, that's a support line. Okay, now it's time to move into trend lines, which is going to be very easy to explain. It's a similar idea to support and resistance. Trend lines also mark turning points in your chart, but support and resistance are horizontal price levels, whereas trend lines link to diagonal points, to diagonal, let's say, turning points. As usual, it's just best if I show you an example on an actual chart, but like I say, don't you worry, you will pick it up right away. Alright, here we are back at our charts. Again, sterling pound against the American dollar, this time around on the 4 hours time frame. We could clearly find different levels of support and resistance here. This could be a resistance level, another resistance level, and another resistance level, okay, there and there. That's a 2-point resistance level. Now, what about support? Well, we could easily find a support level there and another one there with that double point support line. So, 2 levels of support, 3 levels of resistance in this chart. Okay, that's pretty much in line with what we've seen a few minutes ago on this video. Now, what about trend lines? If you remember, the definition of a trend line is it's a straight line linking two diagonal turning points, or rather a diagonal line linking two turning points in price. And the best thing I can do now is just stop talking and get drawing in my chart. Here is one turning point there. That's another turning point, 2 resistance lines. Correct? Right. We've seen that before. Now, what about a trend line? Well, we can link these 2 points in a straight line. That one there, that one there. As you can see, price respected this diagonal resistance level another time there, and finally price broke through to the upside, and well, this trend line got broken right there. Okay. But as you can see, the way trend lines operate is very simple. You simply identify different turning points and you link them up with a straight line. That's it. And that straight line becomes a diagonal resistance level. So what's a trend line good for, or what do we use them for? Like I said before, as long as the trend line doesn't get broken, price is considered to be on from here down to here on a bearish cycle, okay, on a bearish move. Usually trend line breakouts designate the end of either a bullish cycle or a bearish cycle, depending if it's a downtrend or an uptrend. In this case, it's clearly a downtrend, and therefore we have a trend line sloping to the downside, and therefore this has been a bearish cycle. Once the trend line gets broken from this moment on, because the trend line gets broken right there, actually it's right there, from this moment on we can consider the bearish cycle to be finished, and therefore we cannot consider price to be downtrending no more. That's very useful as far as technical analysis trading goes. It's very important to know whether we are downtrending or uptrending, and usually breakouts in the trend lines, like I say, signify or determine those breaking points where an uptrending or a downtrending scenario is in place no longer. So like I say, for technical analysis traders, trend lines are a very, very useful tool in order to pinpoint those turning points in the trends. Okay, now let me show you another example. In this case, the euro against the Japanese yen on the daily time frame. I like to show you a beautiful example of how a breakout of a trend line marked the end of a bullish move, and it gave way to a very sharp bearish period of time in the chart. Okay, as I said, we are looking now into the euro against the Japanese yen on the daily chart. Have a look at this trend line that I can draw from the lowest end of my chart. This is a clear support level. Then we have another resistance level there, another support level, maybe a small support level there as well, another support level there. In fact, it's some sort of a double support level. Then we have a clear resistance level there. Take a look at how price bounced off this level once, twice, 3 times, 4 times before, well, plummeting down again very sharply to the downside. So support levels 1, 2, 3, and 4. We have 4 support levels. How about if we link them up in a straight line, having a trend line? There it is. They are linked up now in a clear trend line, linking this low point here with these support lines, and well, we can clearly determine a very clear trend line that gave way there, right there. Do you see that? Right there, the breakout of the trend line, and how price from there, wow, it dropped down like, well, everyone in this in the market wanted to sell the euro against the Japanese yen. Very violent move. That's usually the beauty of trend lines. Usually, when sometimes when you've seen a rather extended move, in this case to the upside, a bullish move, such as in this case, once you get the breakout of the trend line, more often than not, it's an early indication that price is about to turn around, and that, well, it might be about time to sell the market, okay, or at least to stop searching for buy opportunities. Again, you have different support levels, and you link them up with a straight line, and you have a support trend line, or what's the same, an up trend line. Again, if it's a support trend line, obviously it's always up. If it's a resistance trend line, is always down. Okay, in this case it's a support trend line, since we are linking different levels of support, and therefore the trend line is up, signifying a period of bullish price action. Once it gives way, once again the bears come in control, and, well, you know, the whole picture changes around, doesn't it? Let's go back to the presentation slide, and well, we've reviewed support and resistance, horizontal lines, we've reviewed support and resistance, diagonal lines. Now it's time to take a look into channels. Okay, as we have already established, a trend line is a diagonal straight line linking to support levels, okay, as I said before, on a straight line, and price usually tends to bounce off that level until it breaches through. When it breaches through, obviously in the other direction, that usually signals the end of, in this case, a bullish move and the beginning of a bearish move. Right, now this would be the trend line, correct? That would be the trend line, the diagonal support line. Well, a channel is basically the same thing. It's the same structure, but instead of one line, it's usually formed by two lines within which price bounces up and down. Okay, it's usually a trend line formed by two parallel lines that entrapped, let's say, sort of entrapped price within, and price bounces up and down within that channel. Okay, again, let's go back into our charts for a graphical picture. Alright, here we are at the drawing board, and we are looking into an intraday chart for the USD, the American dollar, against the Swiss franc on the 15 minutes time frame. And we can clearly see this is a fine example of what a channel is, an upward channel. Actually, if you take a quick look into my chart, I can clearly define the bottom of the channel, meaning the support line. Every channel usually has two sides, okay, two sides of the, let's say, of the same coin. There is a support line and there is a resistance line, and both of them should be, ideally, they should be more or less parallel to each other. So that's our support line, with price, with this line holding price 4 times, actually almost 5 times, okay, once there, there, and there. So we are clearly, again, please remember the definition of a diagonal support line. We are simply linking different levels of support, okay, of horizontal support. These are our levels of support where price is standing around, and well, we are just linking them up in a straight line. Now, we can just as easily draw a parallel line, and that will be our resistance line. As I said before, every channel shows two sides of the same coin, the support line and the resistance line, this being the support line, this being the resistance line. As you can see, price is bouncing off that level, of that diagonal line, and therefore, well, as I was saying before, price is kind of entrapped within, yeah, doesn't it? Until this channel gives way, until price remains inside the channel without breaking either to the upside or especially to the downside. Like I said before, until that happens, the channel boundaries will continue working as support. Well, the lower trend line of the channel will continue working as support, and the upper boundary of the channel will continue working as resistance. As I said before, until the channel gives way to either side, this channel will be still in place, and therefore will continue driving price to the upside, since, well, it's obviously sloping upwards, and therefore it's obviously a bullish channel. Now here is another example of a channel. In this case, it's a bearish channel since it's sloping down. Let me draw the channel boundaries for you. The upper band, in this case, it will be working as resistance. The lower band will be working as support. Okay. Oh, there we are. As you can see, they are fairly parallel. They both lines. We've gotten these lines by linking the different levels of resistance as usual, support line linking different levels of support. Pretty standard thing. Again, this is Technical Analysis 101. Price will continue to bounce up and down within the channel until it gives way either to the upside or to the downside. Like I say, until that happens, price will be entrapped within this bearish channel, and therefore the upper band will continue working as resistance and the lower end will continue working as support. And finally, I want to show you another example of what a horizontal channel is. This is usually called a range in the trading terminology, in the trading lingo. But anyway, I'm not going to get into how to trade ranges or anything like that. As I said before, this is Technical Analysis 101. I just want to define what the range is or a sideways channel is. And in future videos, future modules, I'll show you how to profit from them. But in a nutshell, we can clearly establish two horizontal lines. As usual, we have the resistance line, and right below we have the support line. And well, obviously a rather clear horizontal price action, price moving up and down within these two boundaries until the channel, the range gives way either to the downside or to the upside. Price will continue to move sideways, will continue to be moving horizontally wise without any clear direction. Once the channel gives way, which by the way it breaks there, you see that price breaks there. Well, once that happens, bang, price continue moving in on its merry way in the direction of the breakout. Okay, very typical formation. Price enters a period of consolidation. Price ranges or consolidates sideways within two horizontal boundaries. The resistance line there, the support line there. Price topping out once, twice, 3 times, 4 times, and 5 times to the upside, and bottoming out once, twice, 3 times, and 4 times on the lower boundary. Once the breakout takes place there, price continues moving on its merry way in the direction of the breakout. Like I said, the point of this video is not to show you how to make money off trading ranges. You will see one specific video in a future module specifically showing you how to make money off ranges. This video was just to define the concept and especially what a range looks like on your chart, on a real chart. Another rather popular tool among forex traders are moving averages. They've been used for years in a number of ways. Probably if you if you ask 100 different traders, they'll be able to come up with 100 different answers as of why they use them, and you know, reasons both for and against the use of moving averages. In this particular video, I don't want to get into that controversy. That's what future videos are gonna be for, and I'm gonna show you the ways I personally use them myself. But right now, I'm just gonna lay out the details. So let's get back to the drawing board. Okay, we are now looking into the sterling pound against the American dollar on the daily time frame. This is a live chart. This is current market price 144.88. And well, first of all, let's explain what a moving average is, how it's calculated, and then we'll be looking into different potential uses for moving averages. Okay, a moving average is nothing but a mathematical average of the last X periods, the last X bars in your chart, in order to smooth out price action over time. Now, as you can see in my chart, we have obviously different daily bars. I'm just gonna mark the closing points for each particular bar. Actually, let me zoom in a little bit more for a clearer picture. There we are. So this is the closing point for the last bar. this one for the previous one, and so on and so forth. I'm just marking the closing points, okay guys, nothing special here. Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Alright, I've marked the closing point for the last 10 bars, for the last 10 period on a daily time frame. Now the moving average for the last 10 periods on this chart would simply mean grabbing the closing points, the price of these closing points, and get the average. Okay, I would simply sum up all these different prices, divide it by 10, and then I would get one specific value, I don't know, somewhere around there, and that would be the moving average value for the last bar, in this case this one. I would keep on doing the same thing, just going back 10 bars in time and get an average value, and I would get another point, then the previous 10 bars, which would be the last 9 plus another one, and I would get another point and another point and another point, so on and so forth, and I would get finally a line, a line linking all these averages, and that's what it's made. That's what it's called a moving average. Now, as usual, they say that a picture is worth 1,000 words, and I agree. So let me zoom out a little bit, and a little bit more. Okay, there we are. And now I am simply going to apply a moving average to my chart, so you get a graphic idea of what it looks like. I'm going to apply now, and right here I can select the number of periods for the mathematical average. Let's say 30. 30 is okay. Let's pick the color in red. Let's click OK. There it is, and there you have the average. This moving average kind of smooths out price action throughout the last, again, X periods of time by simply grabbing an average for each particular bar. We get the average value in price for the last X. Let's say in this case we were taking 30 period, a 30 period moving average, if I remember correctly. So for the last 30 bars, this is the average value. Now, if we go back 1 bar in time, right there, then for these last 30 bars, we get this price value, and so on and so forth as we scroll back in time. Okay, and that's how we basically get this line, which in a way is it's nothing but a smart way to smoothen out what's been going on our chart, instead of getting this wiki and wiggly price action, which is the actual price. Some traders actually appreciate the moving averages as a way to smooth out price and being able to represent what's been going on in the market. For example, in this case, ever since here, we can see with one single line that price indeed has been going down without the need of actually looking at price itself. Obviously, the longer the period we select for our moving average, the smoother the line in itself will look like. If we change the period from 30 to, let's say, 100, and I click OK, let me now zoom out into the chart. Well, the more, let's say, detached the line gets from price itself. Okay, if you overstretched the period value of any moving average, it kind of loses perspective of price in itself. If we take a look at this chart with 100 moving average period, okay, it was 100, we can see how the line in itself is just way too far from price action itself. Okay, price is somewhere around here, and the line is, I don't know, like 500 pips above. It's way far too detached from price itself. Now, on the other hand, if you tighten in the moving average far too much, let me tighten it in from 100 to, let's say, 10. As you can see, the more you tighten the moving average value, the period value, the closer the moving average hugs price in itself, which it kind of misses the point as a resource tool to smooth out price. Okay, so because well, as price becomes weekly here, as you can see, the moving average line gets becomes weakly in itself and too swingy. So a smart way of using moving averages is to find a sweet middle point without either overstretching the value. Let's say 100, 150. I've seen some people using 200 value for a 200 period value for the moving average. In my opinion, that's just insane. That's just crazy. There is no correlation anymore between a 200 period moving average and price in itself. It's just way too far, way too detached from price. And also I've seen other people using a 5 period moving average, which is just a mess in itself. I mean, let me show it to you. A 5 period moving average. Take a look at that. It's just as wiggly as price in itself. So I mean, you may as well just remove the moving average altogether, because it's just giving you no smooth factor at all. It's just simply following price, hugging price so tightly that the moving average becomes the price in itself. So as I was saying, in my opinion, it's all about finding a sweet middle point somewhere between 20 and 50. It's probably the right answer in my opinion. Okay, somewhere around 30, between 20 and 50. It's probably a reasonable value for the period. Now, again, as I was saying at the beginning of this presentation, if you pick 100 different traders, you'll probably get 100 different uses for moving averages, 100 different values for the moving average period. I mean, it all depends on what use you are gonna give to the moving average. As far as I am concerned, and in order to keep them valuable, you want to avoid both ends of the spectrum, both stretching the value way too far from price or keeping the moving average too close from price itself. But again, as I was saying before, I don't mean to get into potential uses for moving averages, potential applications and ways of integrating moving averages into our forex trading. We are gonna be seeing plenty of that in future videos. Right now, I just wanted to show you what a moving average actually is, what it looks like on your chart, and how to get different moving averages by varying the period value. Okay, and now it's time to wind down to the last tool we are gonna be reviewing on this video, which is indicators. Explaining indicators is going to be a little bit trickier than explaining, say, moving averages, just because there are many of them. There are many indicators. They are all based on different mathematical formulas. So instead of actually reviewing every different indicator there is in the Forex, what I'm going to do is I'm going to explain what they are, what are they for, how they are constructed, and from there, in future videos, in more specific videos, in future modules, we are going to be reviewing each different indicator and their particular use on each specific scenario. Now that was a whole mouthful, wasn't it? Now I understand. It's this may be a little bit difficult to understand. Let's say indicators are like different tools you have on your toolbox. You have a hammer, you have a screwdriver, etc., etc. Each of them have their own particular use for each particular situation. They are not really difficult to use, right? It's just that you need to know which tool out of the 20 or 30 you have on your toolbox, which specific tool to use for each specific use in each specific situation. That's really all there is to it. That's a good analogy. Okay, imagine indicators as tools. We are gonna be reviewing now in this video the concept, what they are, how they are constructed, and in future videos I'm gonna be showing each indicator and how to use that particular indicator in each particular circumstances. Okay? Alright. Okay, let's get going with the concept of an indicator. As you probably know, there are two different variables in any Forex chart. In one hand we have price, and in the other hand we have time. Okay, well, this is supposed to be a T, but okay, that's time, and this is price. No matter what type of chart you pick, in one hand you will always have time, and in the other one you'll have price. Now, an indicator is nothing but mathematical calculation based on either one of those two variables or the other one, or both of them combined in such a mathematical calculation way that as a result you get a third value, the value for that calculation in itself. Now, technical analysis traders like to use those indicators in an attempt to predict future prices or changes, future changes in price. Now, quite frankly, I am not too fond of indicators. I've never believed in the concept of analyzing, or let's say twisting, price on time in order to gauge an idea of when price may turn around in the future. Now, if you ask me, that's total nonsense. Like I say, I've never been too fond of indicators. But anyway, I'm going to plot a few of them on my chart, and I'm going to show you what they look like. Okay? Just give me a second. Okay, we are now looking into the sterling pound against the American dollar on the 4 hours time frame. This is a rather typical Forex chart with two main components on screen. We have the upper end, which is the price in itself, and then we have the lower end with two indicators plotted on the chart. Here we have two of the most typical indicators, the most popular indicators there are. One is the MACD and the other one is the stochastic oscillator. It's called an oscillator because it obviously oscillates up and down. Now, as I was saying before, the purpose for this video is not quite to review all the indicators and how they function, even their mathematical formulas behind. Just take my word, there are dozens, okay, even up to 100 different indicators in the Forex market, so it would be impossible to review them all in one single video. And as I was saying before, indicators are like tools in your toolbox. You just don't pull out one random indicator or one random tool for any kind of job. Okay, for every specific job, for every specific task, you need to pick the right tool. So indicators work in a similar fashion. Not every indicator is useful for every type of market scenario. You really need to pick your indicators of preference, and that's what we are going to be doing in future modules. I will show you, I will teach you which indicators are good for each particular scenario, even though, in my opinion, again, I must repeat, I am not very kind of indicators. In my opinion, the best way to trade is just by using trading itself and trend lines, levels of support and resistance, price channels, etc., etc. Quite frankly, in my opinion, indicators are a whole lot of mambo jumbo that they usually confuse most of the traders, and you don't quite get any extra information you cannot get from price in itself. But nonetheless, on very, very specific situations, I may use an indicator here and there, and especially my own indicators. And well, I will tell you guys all the secrets, how I use them, how I profit from them. And so stay tuned on indicators because there is much more to come. Well, I would say you are pretty much ready now to start working on the actual training program, starting from module number 1. We are gonna get going, like I said before, with the actual training. Now we've been covering the basics on what's Forex, on technical analysis, etc., etc. And now it's time to get busy, okay, to get our hands dirty, and that's what we are gonna be doing in the following modules. But before you move on to the module number 1, I'm gonna ask you to download and install the Metatrader4 platform in your computer. Metatrader4 is probably one of the most popular Forex charting programs there are in the market. It's one of my favorite ones, and the best of all is that it's totally free. Most of the Forex brokers offer this charting platform if you open a demo account, which is totally free. You just need to sign up and you'll get the download link for the Metatrader4 platform right away. You can find the download link right under this video. The platform we are going to be using is provided by the broker MIGFX. It's one of the multiple Forex brokers that offer the Metatrader4 platform. But in my opinion, the MIGFX platform is the most reliable of all of them that I've tried. Their servers are rock solid. I've never seen a server connection drop ever in many years that I've been using this platform. And also they have the lowest spreads around in the industry. So even if you already have the Metatrader4 installed in your computer, I recommend you to use the one from MIGFX. As I said before, it's just a matter of personal preference. In my opinion, is the best one. They offer all the different currency crosses you will ever need. If you remember, at the beginning of this introductory module, we were talking about the 28 major currencies. Well, they offer all of them. Some other brokers don't quite offer all of them. MIGFX does, and like I said, the spreads are rather tight. So go ahead, download it on your computer. There is also a link under this video with a full tutorial in case you have any problem as far as installing the platform. The process is very simple. It's pretty straightforward, but in case you have any technical problems, you can follow the video tutorial where I will show you exactly how to install the software on your computer. Okay, once you have it installed, you can go ahead and get going with the actual training at module number 1, where we are going to be using this charting platform on a daily basis.